Despite manipulation of the consumer price index computation that's meant to pull inflation rate down, we still crossed the 6% mark. And now people think we're going to cross the 7% mark for inflation. And if that happens, how will that affect our investments? Before I proceed, let me do a disclaimer. The 6% is based in a manipulated computation that aims to pull the number lower than the actual situation to make us feel better about things. I personally estimate real inflation to be well above 10%. Some experts say it's close to 15%. Now with the worsening situation, some professional economists are expecting 6.8% for the November figure, but still think there's a good chance that the 7% line will be crossed. So how does this affect your savings? If you have a 10-year IOU issued by the US Treasury with a 1.5% yield, your real yield, coupon minus inflation, is worse. It's a negative 5% yield. The same government that issues low-rate bonds and creates high-rate inflation does this to their savers. It's taxing them. So let's take a look at real after-tax returns on 10-year treasuries. We're close to the worst situation we've ever been in. Even going back, this is basically like the mid-1980s. Back then, 10-year treasury was paying not much more than 10%, and inflation was a whopping 14%. So if you're counting on your money from bonds to buy a house or pay for college, things are not looking too good for you right now. There's money there for sure, and it's more than what you initially put in. However, the value of your money is now gone. So what can you do? You can't turn back the clock, but I personally don't want to do anything while our financial system takes the money that I've worked so hard for. So I recommend diversification and still encourage people to look into everything, but personally, I will not rely on bonds alone. I wouldn't do it. I won't rely on any asset exclusively. There are different ways to figure real returns. Ideally, you adjust the bond yield for future inflation, but I don't rely on the inflation rate that the government releases. That has taken me nowhere in the past, and I don't think these numbers are accurate. Worst case scenario, I'm thinking inflation right now is between 13 and 15%. I need to have a yield, a return on my money that's higher than that. Is it easy to get higher than 13 to 15%? No. Regularly, I still revisit my portfolio to make sure that I'm trying to keep up. One of the things I've always done is have a hedge in my portfolio, which is gold, silver, platinum, and palladium. These precious metals freeze the value of your money. It guarantees that $10,000 now, when I convert that gold or other precious metals, will be able to afford the same $10,000 worth of items I'm buying today, 10 years later. That's how you keep up with inflation. Knowing I have a safe pile, it makes me feel better when I'm taking on some kind of new risk, which I do. Now, I'm not a financial advisor, but you can take all this information and you got to use it and talk to somebody, but you got to look out to plan your portfolio. You can also learn more about gold and silver through our free gold and silver investment guide. So go to our website at noblegoldinvestments.com. That's noblegoldinvestments.com and download it for free.